Hey, what's up guys, welcome back. Today I'll be discussing with you yet another subject of cost of capital. So having said that, cost of capital here in PNG, you can understand that it's very expensive. So if you're borrowing from banks, you'll be given the run for your money. So the kind of banking systems that we have here in PNG is what I call traditional. So the banking system here in PNG, they can't lend you capital at any subsidized or reduced pricing. So in that sense, they will be asking for what is called equity. So equity, basically, in speaking from the bank's perspective, in terms of lending you credit or capital, equity is basically the proceeds from the sale of assets that you have after paying off your mortgage or your loan. Is basically that equity. The banks will be looking for that. If what you offer as security or collateralization, if what you offer as security or collateralization is not sufficient to cover the equity component of the loan that you are borrowing, the banks will be reluctant to lend you capital, which is in the form of credit, against the equity component of your loan. That's one part of it. Secondly, the banks will be asking for what is called cash flow. Banks want to be sufficient in terms of what they are asking for, that you provide them this. So you are providing them equity and you are providing them cash flow. So in one of my previous videos, I made a point that banks, these traditional bankers, they will be willing to risk lending you credit in terms of that you are asking for capital. They won't be willing to lend you credit if you have equity but you don't have cash flow. You are not generating cash flow. Banks will be reluctant to do that. If you are generating cash flow but your equity doesn't cover much of what the bank is asking in terms of the equity contribution that you're making to your loan or towards your loan, the banks will also be reluctant to lend you credit on that. So it has to be equity plus the cash flow, meaning that the component, if it's 10%, if it's 20%, if it's 40%, the banks are asking to cover in terms of that securitization or collateralization, you have to cover that through equity, and then the cash flow is provided, or cash flow is sufficient to cover what the banks call serviceability. Both these elements give to the banks what is called serviceability. You have to have the ability to service your loan as and when it's due. So serviceability is basically to pay off or pay the debt as and when it's due. So that's basically serviceability. So you can see that cost of capital here in PNG is very expensive in terms of the pricing. They give the rates against the premiums and the interest rates that we're paying. It's very expensive. So banks excuse me, banks are not willing to lend you credit in terms of capital because they are traditional and they are only looking at lending to you against the equity that you're providing to the bank in terms of safety, and then the cash flow that you are generating to pay off debt. So without that, banks won't be willing to lend you if you're a startup business or an entrepreneur that you are just making start into your new venture. banks won't be willing to lend you capital because it's very expensive for them to do in terms of the risk exposure that they will be taking into the money that they are lending against. So I hope that clarifies some things for you to understand about capital here in PNG, which is expensive still. With that, thank you, and I'll see you all in the next one.